Are you looking to evaluate a company to purchase? Or maybe you just want to know a little bit more about your own company? Hey, you're in the right place because today I'm going to show you how to use simple financial statement analysis to evaluate a target for a merger or acquisition, and maybe even turn the lens a little bit onto your own company and learn more about what's going on. Today we're going to talk about how to tell an operational story using only the financial statements. So, what's going on in this business? You'll know if you know how to read the financial statements. Hi, I'm David Worrell. I'm the founder and CFO at Fuse CFO. You can find us online at fusecfo.com. I wrote this little book a few years ago called The Entrepreneur's Guide to Financial Statements. It's used in colleges. It's probably available at your local library. And I know you can still buy it at Amazon to use it as kind of a textbook for learning and understanding more about your financial statements. Hey, here's the real problem. How do you know if the books, the accounting records of a company that you're looking at are true? If they are true, what are they saying to you? How do you get the story out of a company, particularly one that you want to acquire, one that you want to buy? How do you get the story for what's really going on? Today we're going to talk about how to look for common mistakes, telling that financial story, and how to actually reconcile the books and create a blow-by-blow picture of exactly the kind of company that you're buying, the quality of earnings, if you want to think about it that way, the actual story, how to compare tax returns to P&Ls to what they call pro forma, right? So we'll be talking about all of that at the very end. But first, I want to go into how do we look at their financial statements and what kind of warning signs can we see in a company's financial statements to help us make sure it's true and then begin to tell a story. All right, let's jump right in. I always begin with the balance sheet. Now, I've had entrepreneurs tell me that they don't have a balance sheet. Unfortunately, that's not true, or fortunately. In any case, the balance sheet is going to tell you an awful lot about a company. It tells you not only their financial position right now, but if you read it carefully, it tells you how they got there. So I like to say a balance sheet balances, you've heard that phrase before, but it balances not because assets equals liability plus equity. If that doesn't mean anything to you, forget it. That's not important. A balance sheet balances because it shows what you have and how you paid for it. It's also called a balance sheet much more simply because it shows you the balance in each account. If you have a bank account, what's the balance in that bank account? What's the balance on your credit card? What's the balance of money that you've reported to the IRS as depreciation? All those things are on the balance sheet. So it's a listing of all the balances of your accounts. And by the way, it does balance because everything you have, the assets, has to equal how you paid for it. Equity or debt. There's only two ways to pay for anything, cash or credit, right? Okay, so that's the balance sheet. And as long as you remember those two little points, we'll be okay. Looking at an actual balance sheet, what you have is at the top, the assets, how you paid for it at the bottom, the liabilities and equity. So what you have includes cash, of course, might include house, land, and furniture. This happens to be a balance sheet for a real estate company that holds a piece of furniture, a piece of property for rent. And of course, they have liabilities, including a mortgage on that. So there's a $1.2 million house on the asset side. They paid for that using a $785,000 mortgage and $400,000 owner contribution. So that was the down payment on the house. So now that we know that this is a real estate business, we looked only at the balance sheet and we know that they own a house and land and furniture, that they don't own computers or cars or internet domains that might be listed there. So we've narrowed in immediately on exactly what kind of business this is and where their money is made. Their money is made by renting out the house and the land. We know the value of those things. We know the what's called LTV, the loan to value ratio, and that is, we know that it's a $1.2 million house with a $785,000 loan against it. If those things were reversed, if you saw assets that were $1 million and $2 million worth of loans on the books, boy, you'd know that they might have a problem. We also know historically what their profits were. Let's go back and look here, and let me delete this out of the way. The Historical profits are what's called retained earnings. And retained earnings in this case, $46,906. Retained earnings are profits kept in the business since the business was founded, or at least since this set of books was started. So we know that this has been a profitable business over at least the lifetime of these books. And we can see how profitable it is this year. $24,004 is the net income. That's the profit for year to date this year. So we look back at retained earnings. I can guess that this business is probably 3 years old. This year we made 24. Last year we made 20 something. The year before that we made 20 something. So there's 46 in historical earnings and 24 in current earnings, making this business about 3 years old. Be a good guess, right? Hey, we also know whether the business is profitable enough that the owner can take distributions. Have they taken any distributions? Owner's draw, 0. Well, that tells you something already. The business may be profitable, but may not have enough cash for the owner to take it out. And I happen to know why in this case, because all their cash is going to service debt, right? Debt does not impact your profits. You have to earn profits in order to pay debt back. So we know by looking at just the balance sheet that the owners did not have enough cash to take a draw. All right, we've learned a lot about this company just from looking at the balance sheet. There are several stories you can tell in addition to what kind of a business it is. We can tell how they're funding expansion. So if they've got a lot of debt piling up in the business, maybe they're using it. The good news is maybe they're using it for growth. The bad news is maybe they are cash constrained and they've had to borrow. So you want to look at what kind of debt it is. Is it long-term bank debt where somebody's really being careful, or is it junk debt, right? Is it high interest rate online loans? And finally, if you're seeing a lot of debt, is the debt matched by assets? This company had $800,000 worth of debt. That might be a crushing blow for a small internet business. But this company had $1 million home to collateralize that loan. And so the liability, the loan for the mortgage, is matched by the $1 million home, the asset. So as long as there's matching going on, you can say, okay, maybe this business is all right. Another story you might see on a balance sheet is a rapid inventory buildup. Now you might have to look at 2 or 3 balance sheets over a couple of years to see this, but if you can see that this company, whichever company you're looking at, has a lot of inventory, you might start to ask why. Is it because they're building it up because they're getting ready to do a giant job for somebody and they know that they're going to need all this inventory? Or is it building up because they're just not paying attention, the inventory is obsolete, and maybe it's not even well counted? Maybe I like to say if you have inventory problems, because I've never seen anybody get their inventory down to be exactly perfect. It's just too hard to go through a large warehouse and count every object and assign the correct value and have it listed on your balance sheet. So looking at inventory, though, can tell you whether they're doing a good job, paying attention, keeping inventory current, and then you can ask a question, is it going up or down, and if so, why? They might have an asset-light business model. You can tell that from the balance sheet too. If they don't have a lot of fixed assets, maybe they aren't buying things. Maybe instead they're outsourcing. So instead of buying a new printer, I'm outsourcing to the print shop down the street. Instead of buying a new truck, I'm outsourcing to an Uber or a delivery service. So think about what kind of business and what kind of assets they have, and then see whether they are building a company to service themselves internally, or whether maybe they're spending a little too much by outsourcing. Outsourcing can be positive too, but it allows you to ask that question. Profitability reinvestment. So look at the retained earnings. We said that those are the historical profits. If you see those going up, as we did in this real estate company, we saw $46,000 of retained earnings and no owner payout. Maybe, as we said before, that's because he's cash strapped and he's making payments to his loan. Could be good news, though. It could mean that the owner is simply reinvesting all of his profits into the business for growth. So maybe in the real estate example, did they buy a second home that caused them to reinvest their profits? So all of those things you can be told from a balance sheet. Now, how do you know that the balance sheet is correct and not lying to you? Right? We've told the story of the business as we see it. How do we know that that's actually correct? Well, there's at least 5 things that you want to look for, red flags on a balance sheet. They're really common mistakes, blunders, but they will absolutely screw up your analysis of this business if you find these things on the balance sheet. Number 1, by far the worst situation is to have negative balances on your balance sheet. The way accounting is set up, every number on a balance sheet should be positive. There's 2 exceptions to that we'll get to, depreciation and owner draws. But aside from depreciation and owner draws, where an owner is actually taking money out of the company, every other number should be positive. If you see a negative number after a credit card or a car loan or a bank account, if you see a negative number, there's something gone wrong with their accounting. It probably is not real. That number is probably a mistake. If it's a negative number after a credit card, what does that mean? It means that it's backwards. They've overpaid the credit card. That doesn't happen in real life, right? I wish my credit card was overpaid all the time, but it's not. That doesn't happen. And so when you see a American Express card with a negative $100,000 balance, you can be pretty sure something is wrong. Okay, inaccurate inventory. We've already talked about. You got to know, is the inventory old, obsolete, or unaudited? Do they have negative quantities on hand? Now, you might have to drill into the accounting records like QuickBooks to actually see quantity on hand, QOH. But if the quantity on hand goes negative, something's wrong. They have used more inventory than they actually own. And maybe their inventory is inaccurate because they have a deeper problem, which is a mismatched COGS or a bill of materials, which is inaccurate. So if I'm selling cups of coffee and I'm trying to inventory my coffee, my bill of materials might say each cup is 2 mugs and 12 ounces, but I'm actually only selling 1 mug with 10 ounces. Things are going to get off the rails really quickly. So look at inventory and drill down on that. Missing assets or liabilities is another balance sheet blunder. Look for things like car loans and personal liabilities. If there's a car loan, there sure better be a car, right? You don't want a car loan without a matching asset. Likewise, you don't want to see somebody's personal credit card on there or personal home mortgage or whatever it might be, a personal car loan without a matching car, or a car that doesn't belong to the business, or a car that's not used in the business. Okay. Fake cash. Boy, this is a big one. I saw this just the other day. The company duplicated its invoices, but because they thought that all the invoices had been paid, they simply marked them paid. The original did get paid and went into the bank. The duplicate still got marked paid. QuickBooks thought that it was real revenue, but it sat in what's called undeposited funds. There's an account in there that says when an invoice gets paid and I'm holding on to the paper check, but I haven't yet deposited it in the bank, that's called an undeposited funds. And it literally means that there's supposed to be cash on your desk, in a drawer, or in a bag ready to go to the bank. In this case, it was just fake cash. It didn't really exist. It was a duplicate invoice that had been marked as paid, but the money never went to the bank, and so it just got stuck in undeposited funds. Finally, commingling personal funds. We talked a little bit about if you see a personal car or a personal credit card on there. Not only is that just bad accounting, it's also illegal and sets the company up for huge legal liability problems, because as soon as you mix your personal funds with the business funds, you destroy what's called the corporate shield. That's a legal term that says limited liability companies and corporations are built to limit the personal liability of the owners. So it's a shield of liability. And when I start commingling my funds or mixing my personal accounts with my business accounts, legally that shield can disintegrate and people can sue you to get your personal funds, even though it was a business problem that they're suing about. All right, very good. So that was the top 5 balance sheet blunders. Let's turn real quickly to the income statement. If you've got an income statement from a company that you'd like to acquire, or you want to look at your own, here's some things that we can tell about them. Number 1, just to get started, you need to know these 6 simple terms. Okay, so hit pause and study this. If you aren't familiar with the 6 basic terms of the income statement, get there. And the one I want to point to, it really is cost of goods sold or gross margin. So if I'm selling lemonade, my cost of goods sold is the variable expenses, the variable costs that I have to spend in order to make the lemonade. Not to build the lemonade stand, not to pay somebody to sit behind it, not to run the air conditioning fan in my face on a hot day, but just the cost of the lemonade. So lemons, water, sugar, ice, cups. That's the cost of goods sold. If you know that about your business and the amount of, don't forget labor. In an accounting business, for example, all of my COGS are labor. So measure the labor that goes into it. If you know your COGS, then you can subtract those from sales and know your gross margin. And that unlocks a lot. All right, so let's go back to our real estate business. What would we expect to see on the income statement from this really simple home rental company? Well, we might want to see rental income. We might see cleaning costs and expenses to keep up the house, right? You'd certainly see mortgage interest. Maybe there's a property management fee. I'm not sure what COGS would be. Would that be like the supplies, the shampoo and the toilet paper and that sort of thing that renters use? Maybe you'd see that. And of course, you'd expect to see a monthly profit. So maybe at the lake or something, and maybe this is a summertime home, and you'd see that the profits go up and down by month. Maybe it's a wintertime home and for skiing, and you see the winter is more profitable. So you might see that. All right, so let's take a look. Just as with a balance sheet, there's 2 main sections: what I sold and how I paid in business, how I stayed in business, what I had to pay to keep the lights on. So let's look at what I sold. What I sold was rent. And this is just for 1 month. So you see up here, we've got August of 2024, 1 month. The rental income was $8,881. Now, typically there would be a cost of goods sold section here. We should have that toilet paper and shampoo and coffee expense under cost of goods sold. It's not there. That's a really common mistake. And so I wanted to point it out because if your business or the business you're acquiring does not know what it costs to deliver their product or service, almost nothing else matters. You've got to stop what you're doing and figure that out right now. Okay, so we'll assume that we can fix that if we wanted to. Down below is how we stayed in business. Now, it might be commingled with some of those supplies. There they are, in fact. Airbnb supplies, $515 for 1 month. So now we can know we've got to avoid or discount that amount. But we see some interesting expenses here. Interest expense from the mortgage, that's understandable. Decor, linens, durables, etc., understandable. Travel, not quite sure what that might mean, but it might be a question you want to ask the seller. Why did they have to travel, or what are they spending travel money on? And utilities, $600 a month for utilities. And you're going, holy mackerel, what is that? And the owner's going to tell you it's a Netflix subscription and internet and a telephone line and the heat and gas and electric and water and trash and sewer and all these things. And you want to drill down on those to make sure you understand what he's spending on utilities. Total expenses, and of course, net operating income. Now, there's one more problem with this P&L that I wanted to leave in there for you to look at, and that is, why is interest expense way up here? Right? Are you familiar with the term EBITDA? We would expect earnings before interest, taxes, amortization, depreciation. So we would expect the interest expense to be below the net income line. Because some people might own this house and have a mortgage, some people might own the house without a mortgage, and we really want to compare just the true operating expenses of this house. So that might be a mistake. Maybe interest expense should be below the line. If you caught that, good for you. Here's 5 other blunders that people make on their income statement. If you see these things, big red flags, you want to ask lots of questions. So number 1 would be uncategorized income. I hate a P&L that doesn't tell me what they sold. You saw in the last one, at least it was called rent income, right? So we know that they were renting the house out. You can't believe how many companies I meet that have a one line that just says sales or revenue. You don't even know whether it's something they sold or rented or stolen from somebody. So they just say revenue. That's really terrible, and it gives you an opportunity to really drill down and say, let's break this out by business line. Let's break it out by product category and see which of our products and which of our business lines are most profitable, or even just selling the most. Do I sell more red widgets than blue? That would be really important to make decisions on. Number 2, missing COGS. We already mentioned this because the last example was missing the COGS section. If you mix your cost of goods with your overhead, or you simply don't know it and aren't measuring it, then it's really hard to set prices. You won't know your break-even sales, and most of your analysis is going to go right out the window. So make sure you have a COGS section first, cost of goods sold. Commingled expenses we've talked about, but you can find them on the P&L also. Look for things like country club memberships, nail salon visits, groceries from the grocery store, gasoline for a car that's not a company car. All those commingled expenses are going to get you in trouble. Number 4, no EBITDA line. We talked about this one also, right? EBITDA is earnings before interest, taxes, depreciation, amortization. So if you see interest or depreciation up in top, you might not find an EBITDA line. Every good P&L should have an EBITDA line, and then the ITDA, interest, taxes, depreciation, amortization, below that, so that you can evaluate what's the operating profit. We often substitute EBITDA for the word operating profit. What's the profit made from the core business? And finally, too much detail is my own pet peeve. I've seen P&Ls that are literally 16 or 20 pages long. If you have a 16-page long P&L, it's not going to tell you anything. Too much detail, hard to analyze, hard to get your head around. Am I making any money? Where am I spending it? That sort of thing. So you want much more broad categories that are going to capture more of the expense. Get that P&L down to 1 or 2 pages and start so you can see all of it at once and say, that's where the problems are coming from. Okay. Here's a golden rule of financial statements. Everything is connected. Everything is connected. So if the balance sheet is wrong, the income statement is also wrong. If the income statement is wrong, pretty likely the balance sheet is wrong. There's only one thing you can do in accounting, and that is reconcile the accounts to the bank statements. That means reconcile your credit card to the credit card statement, your loan to a loan statement, your bank account cash to the bank account statement. Reconcile, reconcile, reconcile. When you do that, you'll fix these things, mostly. And then, of course, you have to know accounting well enough to actually put the numbers in the right place. Do they go on the P&L or do they go on the balance sheet? Above the line or below the line? So get a good accountant who can help you with that sort of thing. All right, the last quick chapter for us is, now that we know the numbers are true, what do they mean to you as the buyer of a business? Or your buyer if you're selling your business, right? Or your own business. What do those numbers mean and how do you explain it? Well, in any given M&A transaction, we're looking at a tax return, we're looking at QuickBooks, and we might be looking at something called a pro forma from the business broker or from the business owner. And a pro forma is meant to show us the seller's discretionary earnings. Some people call that discretionary cash to owner, DCO or SDE, or just the likely go-forward cash available or profits available to the new buyer. So a pro forma takes the income statement and turns it into, it strips out all of those things like the country club memberships and the personal credit cards. It strips all that out and shows you what the business would look like if it was run properly and accurately and truly. Perhaps even under your management, you would do things differently. So you can have a pro forma for that. And finally, the bottom line of that pro forma then is your seller's discretionary earnings or discretionary cash to owner, depending on what you call that. So here's an example of how I look at this in order to come up with a meaningful statement about everything that we've seen. So we've seen a lot of facts. We see the QuickBooks, the tax, and this pro forma or SDE. And I created and used this little spreadsheet to tell me what's going on. So for example, QuickBooks told me that my total cost of goods sold was $4.3 million. But I looked at the tax return for the company, and it was $4.4 million, almost 4.5. There was a difference of $127,000 between QuickBooks and the tax. Why was that? Well, when we investigate, what we see is that taxes count different kinds of salary as COGS, and they forced us to consolidate what we had down as officer salaries or office salaries down below up here. So it was taxes were asking for a different mix of salary expenses, and we can show that, and we can then make a note and make everybody comfortable that yes, indeed, QuickBooks matches the tax record, and here's why there are some little differences as we go. And each of these numbers down here with a yellow flag explains why there's a difference. Salaries for the shipping department were $92,000 in QuickBooks, but they were completely missing in tax. Maybe that's up top under the cost of goods sold. Maybe that's part of that $127,000. So each of these little yellow flags is a reason why the QuickBooks and the taxes are different. And if you're buying a business or you're looking at your own business, you should be comparing QuickBooks to tax and making sure that you understand why your tax preparer did it a particular way and what it really means is going on in your business. Likewise, with the pro forma or seller's discretionary earnings, you can compare those to the QuickBooks and you can say, what are they taking out? So for example, a really easy one down line 21007, salaries of officer. Well, the officer is probably the owner of the business, and he took a $302,000 salary last year. That becomes the benefit of the new owner, right? The buyer. So the seller's discretionary earnings that the buyer is going to have to decide how to spend that includes that salary that comes with owning the business, $302,000 salary that the owner was paying himself, and now the new owner can pay himself. So salaries for owners, there's an office salary of $60,000. I think the note there is that the owner employed his child or sister or spouse and paid them $60,000. So that was additional discretionary earnings that we felt the buyer could use as they saw fit. And when we add all those things up, you can't see here, I cut it off, but we add all those things up, the buyer of the business is going to know what is the discretionary cash that they get to spend. And when you lay it all out in this nice 3-column format, boy, it all becomes obvious. There's no cheating going on. There's no red flags. There's just a different way to look at the same numbers, and we can prove that they're the same because we've done the math to show that. So thank you very much. My name is David Worrell. My business is Fuse CFO. You can find us at fusecfo.com. I am happy to help with the due diligence, the quality of earnings, and anything else that you need to make a merger or acquisition process go more quickly. If you're a business broker, I'd love to talk to you. If you're buying a company, we'd love to talk to you. And if you just want to know more about your own company, great, let's have a conversation about that too. So until next time, please hit subscribe, like, pass it along, share this with a friend. I appreciate you. See you then.